Today, before the open, because I've had so many people ping me, hey, May, Upstart down 17%. I need you to do a little bit of it. It would be so wonderful if you would do the rundown on Upstart's quarter and what happened. And honestly, I missed shorting this one. Okay. And at 50 something dollars the other day, I was like, oh, I might be in that stock. And really, I was thinking to short it. But you know what? My money was not where my mouth is. So I don't get to take any kind of victory lap, which sucks because actually, I have said for some time, and the only reason I lift my foot off of the gas pedal on this being a short was because in the first quarter, they got funding from a couple of asset managers, direct funding, which allowed them to move the loans off book. And this quarter was particularly bad for two reasons. Number one, I'm going to go through the financials. Number two, I'm going to explain why this quarter was actually far worse for me specifically listening to it than I would have anticipated. Disclosures, past performance is not indicative of future returns. I currently, sadly, have no position in this one way or the other, but that may change after the open. Let's see. Okay, let's go. Oh, and then this is not investment advice. Obviously, you need to do your own due diligence. And quite frankly, if you don't understand any part of what I'm saying in this video as relates to lending, as relates to financial stuff, just stay out of it because this is going to get really volatile. Here's the challenge with Upstart. Upstart has somewhat of a cult following, but most of that cult following does not understand lending well enough to be in this stock. Let me just say it what it is. So this thing will jog up and down, up and down. It will not be institutional that is interested in this because anyone institutional that looks at this should be thinking this thing is a short, and we're going to go through why. All right. Let's go through it. Hold on. Let me just make sure I have the right one here. Okay. Let's go through the very basics, what the day traders will look at, what anyone will look at, and that'll just be the income statement because this is what everyone is. This is the easiest of the statements for a lot of folks to read. Okay. Income, revenue down 40%. Operating income was a big fat L. Net income was a big fat L. And if you look at it was a big fat L, even though they took sales and marketing down. Okay. That's not good. That means that essentially my thesis, which was this was my thesis from the other, from before. Okay. My thesis from before was really simple. I wish I'd copied over the slide, but you can go back 2 to 3 videos ago and you can see that my beef with Upstart was that they are a loan originator that because they have over $1 billion in loans on balance sheet has turned into a loan asset manager without any of the background requisite people on staff or any kind of understanding of the industry to be a loan asset manager. And if anything, they proved that in spades. If it was confusing that that's what they didn't understand that they were doing, they made it crazy abundantly clear on this call that they do not understand that that's what they've done to their business model. And as an institutional investor, if you're still like, yeah, let's take a flyer, then more power to you. But typically, when in the middle of the worst environment, someone who does not know what they're doing decides to change their business model towards something that isn't new, but is actually very old and established, i.e. loan asset management, you short that thing, okay? So now let's go through the rest of it and describe exactly why I'm telling you they had no idea what they ended up doing. So first, I made this little diagram many moons ago. This is what where loan origination should sit. When you originate loan, some lady or gentleman or whatever gender we want to call it these days fills out an application. It goes to the originator. The originator then passes it off to the investor. If you're going to stay a pure play originator, which is what they were, you have a limited time on how long and how much you get to hold on balance sheet to maturity. That is your job. If you are holding it for longer than that, and if that size gets way beyond what even most asset managers have on balance sheet, let me tell you how long it takes for you to be a loan hedge fund, to be a credit related hedge fund and raise $1 billion in assets so you can buy $1 billion in loans. That is not something that happens even overnight. Okay. That is something that happens over the course of a decade to get to that size. And then it's easy because it scales upward from there. But But you as a loan originator should not be getting $1 billion in loans on balance sheet. And that's ignoring the fact that you securitize a bunch of loans on top of it and pass it off. Okay. But they now have $1 billion on balance sheet held to maturity, even though they keep swearing. I'll show you that on balance sheet so you can see how weird it is. And then the investors, what they're supposed to do is give it to the investors, and then the investors will either keep some of it if they're a proper asset manager, or if they're a bank, a private equity firm, they may co-invest with a bigger asset manager or whatever it is. Okay. This is the funnel of liquidity and what's happened thus far, because essentially at this level, the bank is deciding that it does not want to take on the risk of passing it to the bigger asset managers. They've shut off the faucet. That's what my little faucet thing is. That's my way of being clever, whatever. Okay. That's what's actually happened in the space, is because the banks, and the reason that I took the foot off the short pedal last quarter was because it looked to me like, given what they were saying, is that they were going to more aggressively attack these two types of folks that also will take your loans off balance sheet. The private guys, private high net worth, private wealth folks, alternatively, or they had some really big asset managers. They're like, look, we don't want to originate, but we will certainly buy whatever you originate. If it's a good loan, we'll take it. So I thought that we were going to hear a whole nother quarter of them finding more of those folks to take this stuff off balance sheet and bypass these guys right here, which were the banks. Or alternatively, you are going to see this trust securitization vehicles, which are now clearly in the queue from the previous quarter, but are stated even more in this quarter. It's in the queue. It is not in their deck at all, which is part of why I'm telling you they have no clue what they're doing right now as far as like how they're transforming the model. Or if they do have a clue, it scares me. Anyways, this trust vehicle could technically go to just bigger asset managers, but if they had created some better funnel between these two, such that they could just go direct and like just then more power to them. I thought that was what's going to happen. That very clearly is what is not happening right now. Very clearly. And if I was confused, the last gentleman on the call, this British guy, who absolutely was asking what I call a British question, which is, I'm going to ask a rhetorical question and give you a chance to clarify. But really, if you fail to understand my question is rhetorical, then what really happens is I just took the piss out of you in public. All right. We're going to go through that. This is the balance sheet. You can see that they increased cash a touch. Some of the loans came off, but we're still at almost $1 billion worth of loans. The challenge with why I'm saying this is no good is instead of discussing how this was going to continue to get smaller, these loans at fair value, they talked about the fact that they're co-investing with others. Co-investing with others? You're an originator. What the hell are you doing? And they're like, no, the reason we're doing it is to prove our business model that we have this, what they call, hold on, I got to get the words because they came up with some new jargon. All the young people coming up with new jargon for stuff that has existed for freaking centuries and decades. But, you know, parallel timing curve calibration, which is, by the way, not back testing. So that is what the gentleman at the end taking the piss out of this guy was actually asking very directly. So they've got this parallel timing curve calibration. And the gentleman at the end, British gent, says, hey, you know, this parallel time curve calibration thing, it kind of sounds like back testing. Can you explain how it's not back testing? Because maybe I just don't understand. It's back testing. Okay. And I'll go through what they described was that they are doing, like, unlike, this is what they described, just for anyone that's actually in risk, you'll see how silly it is, right? They said, well, unlike back testing, which is always backward looking, right? Okay. Always backward looking. Unlike back testing, what we do is we pretend like we initiated the loan today and then recalibrate according to our AI models, given the data that we have. That's actually what asset managers do once we buy the loans, guys. That's back testing. That's what asset management back testing is. And all that did was scare the bejesus out of anyone on the other side of the call that's actually an asset manager of loans, that you for the first time are understanding what that business is, and now you're making up jargon that already exists. That's what actually happened on the call that is so problematic. Because when you get a book of loans, when you buy a securitized book of loans, you're, as a risk side, or if you're someone that's a young analyst. You can look at the historical performance of the loans, but at some point you're going to be asked to do a series of scenario analysis and then backtest it during different environments. You want to call it a forward test, whatever, but no one does that. We just call it backtesting. It's all one thing. Anyways, that is a gigantic problemo, given that what they're now doing is co-investing. Couple of other things. Let me just show you. So this is the co-investment. 40 million in initial capital. It's not that big in theory, but it's what they're doing in their thought process right now. Minimum zero, maximum they think it could be an 83 million investment with a $40 million initial. They think the current discount is 51. To be fair, I actually think they're going to be okay on that, because that actually presents a very high discount rate on those bonds, such that they might be okay. The challenge is I'm not convinced they understand their business model. That's the problem. Okay. Here is what they have: lending by product. You can see it's still the autos business versus the credit business. There you go, in millions. Yeah, not getting better. It's actually getting higher. You can kind of see across all business lines. This was their guidance, which is an L for next quarter and an L both in net interest income loss. That has to do with the loans going poorly and going against them. And then this 2 million net income loss as well. So they're basically going to become an asset manager of loans in the worst possible environment. In some ways, this would be a great environment if you are capital rich. They are not capital rich because, quite frankly, they have the cash on balance sheet that you should have to be an originator, not an asset manager. Okay, what do they actually have? Let's go back to it. They have $443 million worth of money against $837 million worth of loans at fair value. Okay? And they still are originating away, which they would about to the tune of, let's look at the cash flow statement. They're still doing, let me bring that forward. They're still doing about 1.2 billion in wait, let me bring this forward. Okay, so they're still originating and about $1 billion worth of money every quarter. You can kind of see how this is increasing as you go. Let's see. This is something that is deep in the heart of the queue. And it's the question that I wanted to know every single time. What exactly is the nature of this book? They still don't give us the nature of the book in the actual deck itself or have a reasonable discussion about that. And that is, again, a testament to the fact that they do not understand the difference between being an originator and what it would mean to report appropriately if you were an asset manager of loans, okay, or of credit. This is essentially, this is what they wrote. The following table represents the company's level 3 fair value measurements on held for investment, held for sale. And they write this weighted average credit risk of 17%. Okay. Here is auto loans ratings by credit score. And you can see that that means that this is a subprime book of loans. That's a subprime book of loans. All right. So they are seeing losses increase, which is why, I mean, another way to show it would just be to see that the credit risk is increasing, prepayment is reducing because you know what it is. And then you're seeing the discount rate increase. So this is subprime book of loans, guys. Let's just call it what it is. They are subprime credit lending company. That's what's happened here. And when asked about this, and when asked by this gentleman, hey guys, what you mean by calibration, la, 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 that sounds a lot like back testing. What they said suggested to me that they don't necessarily know what it is the asset management business does to test out the loans that they buy from Upstart as an originator. Okay. And that is all I have prepared. I don't know if there's any questions or anything. All right. I don't see too many questions. Haven't followed the stock. It rose 200% year to date because essentially, like me, so I started to go positive on it last quarter when it was $5 because what they said on the call had to do with the idea that they were getting new money in to take the loans off balance sheet. Okay. If you look at the March quarter, you'll see, I don't know if I have a way to show it here. You'll see that the debt came down from like 1 billion to 900 million, and most of the call was about the fact that they had come up with a bunch of private and asset managers to step in for the banks that were not going to be there for them. But unfortunately, that's not what this call was about. This call was about how they felt like they were doing a great job with making these loans, and that the worst call ever. But that given how fast the environment is deteriorating, they came up with this new modeling technique that is even better than their old modeling technique, parallel time curve calibration, using AI, which necessarily has a place within the debt issuance market. Sorry, not the debt issuance market, within the loan origination market, and could help all of debt in general. And that statement and the way he said it demonstrates zero understanding of what credit desks have been doing for the last 20 years of like trying to be able to properly assess the risk of their book, as well as calibrate it to a changing market environment. That's what I heard as someone who has been hanging out in finance for 20 freaking years. Okay. So like 25 years. Okay. That's what I heard. I don't know what other people heard, but I'm pretty sure that if you've been working in debt for 20 something years, you heard the same thing I heard is that, so that's why it rose 200%, because all of us in Q1 heard they've got a conduit that bypasses the banks so that folks that are on the asset management side don't have to buy their securitization from a bank. But this quarter, they showed zero understanding of that slide that I showed you with how liquidity flows and where they sit. Hopefully that clarifies that question out. I feel bad. Look, I'm going to just say this. I want this management team to succeed, because honestly, if they can just get back on the right page of what they're doing, there is actually a desperate need for someone to create a conduit that bypasses the banks right now. I would be thrilled if they would be the one to do it. But you can't be talking like, oh, we're going to securitize, we're going to issue securitizations direct from Upstart. You're also not a broker dealer, kid, with all due respect, because actually that CFO is younger than me by about a decade. So very smart kid, don't get me wrong. But at the same time, you got to be careful to not get out of your lane, because those other lanes are way more dangerous, number one. And number two, those lanes have a whole type of regulation for which you are currently not doing any of that. And I don't want you to, because it's a much more expensive operating structure. So that's kind of my issue. But I do want Upstart to succeed despite all of the what was that, because you are getting kind of my initial reaction from the call. So I apologize if that's being perceived in any other way. Any other questions? You guys put them in the comments now. All right. I know it's like first thing in the morning. Some people are just doing their morning routine. If you have questions, stick them in the comments going forward. But this one's really tough. I don't know if I'll take a position on them, honestly, because I don't know. I'll have to think about it. If 4 billion in market cap is what I'm seeing, I have to double check, because all the market caps have been wrong in all these data feeds recently. But at 4 billion in market cap, and you seeming to not fully understand that you are transitioning from being a loan originator to, at a minimum, you are a loan asset manager, but you also started to talk to me like you are trying to be a loan securitization firm, which would make you actually kind of a broker dealer at that point. Because if you're gonna bundle them and then try to sell them off direct to asset managers, you're really something special at that point. Yeah, then I got to really think what valuation makes sense for you. All right, guys, have an awesome morning. Hope everybody makes a lot of money on their trades, and see you next time.